Guys, thank you so much. It is 5 o'clock on the dot. We'll wait for some people to filter in. But this is a fund update call that we're doing. I will share my screen in just a moment. So thank you for joining us. It is October the 23rd, 2024. This is the Theta Alpha Fund update call with Omar Khan, Matthew Todden, and David Jarvis, who's the portfolio manager, Quarton Capital, and is our IFM for the Theta Alpha Fund. Okay, so welcome everyone. This will be posted onto YouTube over the next few days. So please check us out there if you haven't already. There will be a replay over there. So good afternoon to everyone. Okay, guys, let's just get into it. We are talking about what's the ongoings of the fund. And we're going to talk exactly about where we are in the fund and what we're looking to do going into the last few months or last 2.5 months of the year. And really, in terms of trading, I would say it's probably the last two, not even the last half. That back half of December, traditionally lighter volumes. Sometimes there's a lot of play, but oftentimes it's a bit of a sleepy half month. Okay, so we're going to talk about some seasonality and what we're doing with the portfolio given this seasonality. And we're going to explore like how we're going to make, not how we are going to, but how we make this type of portfolio more or less alpha, as the name implies. So we do need data for this, guys. So historically, we've seen how the stock market performs, and this is a chart from 1971 to 2023. So a great deal of data here. Obviously, I'm always.
I was going to say, Matthew. Although I think if you think about it, most likely most people think about October being a terrible month, but actually it's not a bad month at all.
Not a bad month at all, especially the back half of it, because you're leaning into that November-December timeframe where general liveliness and upbeat type of things happen in the stock market. I know there's some seasonality items like IT budgets are exhausted, and that puts a little bit more demand on companies that produce electronics. You have that little bit of a phenomenon there. But generally speaking, yes, you are seeing this, like S&P has risen 70% of the time, right? 72% of the time of the Dow Jones, NASDAQ 68% of the time. So let's just aggregate that up to 70% of the time these broad markets are going up. Obviously, we're more concentrated or entirely, actually, I'd say not entirely, because there's Eli Lilly in the mix as well. We are mostly concentrated within the NASDAQ. So looking at this, and I'm seeing 70% of the time, the average is 3.4%. That's with 50 years of data. Granted, the 50th year of data, I'm not weighing so much, but this last year, last 5 years, yeah, I'm going to weigh that a little bit more heavily, just in my mind, not really on a spreadsheet. But I'm seeing here, yes, there's a better chance of this, of the markets going up, and a good amount, right? If you were to take this and kind of aggregate it over the year, annualize it over the year, it's not such a bad return. What this means to us, guys, is that we have a little bit more liberty in saying, listen, we might just go long more stocks, and we also might be writing options closer to the money to pick up that yield in case there's a little bounce. We're kind of more okay to pick up the stock at these prices, right? Knowing this type of data, and that's how we've been trading the portfolio right now. I do believe that there's a little bit of volatility in the market until we determine who a president is, hopefully sometime this year, officially next month, but we shall see. But I would like
Let's
to
see what happens.
Let's see what happens. But I anticipate a president being announced in 2024, and we'll leave it at that. Dave, do you have any thoughts on that?
Yeah, I think saying that it's bounded by 2024 is probably the best prediction. I don't think we're going to know who
it's like an over-under almost, right?
Yeah.
You want over 24? Do you want under 24?
I don't think we'll actually know on election night.
Yeah, I agree.
There will be some challenges. There'll be late reporting. There'll be some very, very, very close states where they're missing mail-in ballots. There'll also be the inevitable legal challenges. Listen, in one way, I think the best thing that can happen is that it's unequivocal, whether it's for Trump or for Harris in terms of this election. I'd much rather see an unequivocal outcome so we can get on with the business of business. That being said, I just don't see it. And uh, no surprise, I just don't understand how anyone can vote for Trump. End of conversation.
How anyone can vote for Trump?
I don't understand how anyone in their right mind can vote for Trump.
Oh, really? Interesting.
Right.
Well, market-wise, quite frankly, I don't think it really makes a difference. That's kind of what the numbers show. I would also say that I think we are basically sellers of volatility in this portfolio. And I think I would say that there's a little baked in volatility premium in the market until this is all resolved. Um, Outside of any volatility baked in from earnings or other kind of global political events. So I think I would like to see one uncertain event become now a given, whoever that is for the next 4 years. So as to further David's point, we get on with the business of business. But we'll take it if there's volatility to be had. We'll take advantage of that as best we can inside the portfolio. Okay, let's keep moving on here, guys. So this is where we're coming from in terms of what we're looking for. We can see here Labor Day to year end. So, literally the last 4 months, September, October, November, December, the last 4 months. You can see here that, an awful lot of weight is in this middle line here, guys. 70% across the board, pretty much on average, higher days, right? And, the worst period, like look when the worst periods are here. Like, you don't even need to be a stock market expert to figure out why 87 was a bad year, why 2008 was less than stellar, and what the heck happened in 2000, right? These are like this blaring out at you that these are the worst periods. So I mean, if this is considered outlier data, I'd gladly take this out. I'll also take out, just to be fair in any analysis, the best periods as well. And I bet you those skew these numbers as well, right? So, very good likelihoods that the that an upturn of the market will be seen between Labor Day and the end of year, which puts us in good stead to be a little bit more aggressive in the portfolio and try and finish the year strong. We had a decent September. Hopefully, we're on track for a decent October. But yeah, I think this puts us in good stead to trade with a little bit more conviction going into the last few months of the year. Okay, let's continue on here. Okay, so stock market predictions. So these are always fun. I remember I was at a CFA event, and this guy says we're in one of the only industries where if you're right 2/3 of the time, you're literally an all-star. And if you're right, less than half the time, you're like, what did they say? He said if you're right less than half the time, you're a invaluable contrarian indicator. So these predictions are always good, but we can see what data we can gain from them and what kind of knowledge we can gain out of this. Now, Brooke Thackeray, he's like the resident kind of North American expert on seasonality, and he sees, like, here we're showing like the last like 50 odd years, how the S&P, Nasdaq, and Dow have increased over October, November, December. And what I'm garnering here, guys, is basically like it's all positive, right? Is it reasonable to have a 1.5%? Let's just say this whole table averages up to 1.5% per month. So 1.5 plus 1.5 plus 1.5, that's 4.5%. If you annualize that, that's significantly higher than the average return in the S&P for the last 50 years, which is hovering at about 10%, right? So again, is it doable? Yes. Like these are good data points to have in terms of trading with more conviction. And it says here, and I've painted the data points to a possible strong year-end finish for indices, right? The question of the broader market gains versus gains in specific sectors, such as technology, which led the stock market to higher gains in the first half of 2024. So again, and I'd say lastly, like we've spoken a little bit about the presidential election, and we haven't spoken about the Middle East concern. Obviously, a very, very tragic situation there. That will heighten volatility with Iran's involvement. But like at the end of the day, we're not going to be political here. But at the same token, like we do acknowledge this as a risk, and this is one of these things. Like we've debated this a lot. It's like how do you hedge for geopolitical risk? And I think the short answer to the long drawn out question is like you can't. So again, this is a risk we just need to be aware of and monitor. David, like not necessarily Middle East specifically, but geopolitical risk. Like, how have you seen that kind of addressed in your past lives?
So it's interesting because um, if you go back through history, geopolitical risk really did influence the markets. And during the Bay of Pigs crisis, for example, the stock market in the U.S. Went down, and so there was, or sorry, the Cuban Missile Crisis, which was just after the Bay of Pigs. But during the Cuban Missile Crisis, the U.S. market sold off, and there's wonderful stories of um, floor brokers, basically, as the market sold off and got really, really low, they basically bought everything, mortgaged everything, and went long, for the simple reason that if there was a nuclear exchange, who cares about settlement? And if it was resolved, then the market would scream back up, and they did well. But what's been really fascinating from my perspective over the last almost 40 years in the business is how we just simply accept it as part of the fabric of the background in which we invest. There is very little. It's just we shrug it off. We know that there's issues. We know that oil could take off, depending on what kind of response different countries make to each other's energy programs. But what's it's just very interesting that over the last 35 years, we just acknowledge that it exists, and we just dismiss it from our analysis, and we actually don't really factor in much of it, other than perhaps a few very sophisticated investors buy deep out of the money puts or something like that in case there's a surprise.
Yeah, it's a difficult one, and usually these days, it's acknowledged, and like you can have theories would say, okay, well, let's gain more exposure to like the Raytheons of the world, or as David was saying, like, deep out of the money puts, but like, buying insurance, unfortunately, there's an expiration on insurance, right? So, maybe that works. Are you betting in this situation, are you betting on Iran attacking a zone and there being retaliation within a certain point of time? Like, it seems a little dark in my opinion, right? It seems like, wow, what exactly are you trying to insure against, right? So again, I think it's more of a monitor and watch, and we're actually quite comfortable with like, listen, there are geopolitical risks with some of our companies. We acknowledge there's some geopolitical risks with TSMC, which is one of our holdings. But again, like I would argue that the AI boom, it would potentially overshadow that type of geopolitical risk, but we will see, right? Like, we have earnings coming out this quarter, actually this week, over the next week or two, and we can see how they go. But like, I would also think that these companies are fundamentally strong, and potentially it creates a buying opportunity, right? But again, we have to assess each risk factor as they come along. Okay, let's keep moving on here. Where's my button here? Did I skip a page? No, I didn't skip a page. All right, so actually onto the portfolio, guys. So Alphabet, interesting story about Alphabet. We'll be issuing a research report on Alphabet very shortly. They have been in the news and in front of Congress recently with like lawsuits and whatnot. We are monitoring that. We're smidgen above the desired exposure. We're pretty content with that. Same with Amazon. We're very interested in their cloud business and what comes of that. It's going down. I'm not going to go down the list entirely, but like, Apple. Again, we're waiting to see like what the impact of AI is on the new set of iPhones, and we may find out about that next week, right? So at the end of the day, like, we do have exposure to the stocks we want to have exposure to. Bitcoin at the very bottom at like 4.1%. Bitcoin is becoming more and more prevalent in the news and being more and more accepted. So we're very happy with that lower level of Bitcoin exposure. And again, our semiconductors, we're quite happy with our positioning over there. To round it out, we obviously have Eli Lilly, and that's been performing reasonably well for us. And we are looking to add, but at the right price, because as we can see in the market, all-time highs are like kind of the new thing on the block, right? And the market seems to be an awful lot resilient, and we're going into a better time of the year. So as some people say, the best indicator of an all-time high is a previous all-time high, and I think that's kind of what we've been seeing over the last little while, and perhaps what we'll face a little bit going into the end of the year, right? Okay, gentlemen, any other comments on the portfolio construction? This is as of last week. Any other comments, you guys?
I can point out that Tesla kind of surprised everyone in the sell-off today. In the aftermarket, the
Yeah,
stock's up about 13 to 18 bucks. So guess
Yep.
everyone
Yeah.
liked it.
Yep. Okay. And I'm not sure we'll be discussing this in a future call, but yeah, you're absolutely right there. Summary fund position. So we have 21 outstanding puts as of October the 18th, guys, representing about 9.4% of AUM. So a good chunk there. Seeing if we're going to get hit on those. We don't mind getting hit on those. These are always within our target price range based on fundamentals and technical. So, they're well defensible positions here. Number of long positions, 12 positions. We know we like to have a concentrated portfolio where we have in-depth knowledge of the companies that we are trading in. And yeah, so far, average number of days to expiration, 22 days, well within that time frame where Theta starts to decay at its most rapid pace, right? So we're quite happy with that number of days, both on the covered call side and on the put side. So yeah, so for the portfolio construction, we're fairly pleased with. And yeah, we have to see how these macro stories and macroeconomics kind of play out, right? There's a number of stories on the horizon, guys. Obviously interest rates and inflation. I would like to think that story is coming to an end. I don't know for sure, but it looks like the final chapters are being written there. Interest rates have a long way to go, but I think we've seen that the trajectory
Yeah,
is
Matthew,
down.
I was going to say rates got cut by 0.5% today, right?
Yeah, in Canada. Yeah.
Yeah.
So, I mean, we are Canadians that invest in this product. Yeah. Interestingly enough, but our stocks in this portfolio are driven primarily by interest rates in the United States. Well, as their input, right? Not necessarily Canadian interest rates, but yeah, 50 basis points down in Canada. That's pretty big. And on that note, we'll need to see how fast that trickles through the economy in different sectors, meaning like how fast do businesses start to accelerate their plans to grow? How quickly does the housing market pick up, if at all?
Yeah.
And we do hear lags these studies on these lags are, I don't know about you guys, but like they seem awfully frustrating. It's like the lag is like 6 to 18 months. Well, hey, that's a 150% range in the lag, right? Like I don't understand how you can really act on that.
I
Omar,
don't
David.
think, Matthew, it'll be as quick as most people anticipate. It'll be a bit slower. You have rate cuts of 50 basis points, let's say today, and let's say in December. It seems like people are waiting on the sidelines for this rate cut cycle to happen. So we'll see what happens.
Yeah, David, any comment on Canadian rates this year? This
Just a couple of things.
Yeah, what do you think, David?
I wasn't surprised that there was a 50 basis point cut. Canada's really slowing down. That's self-evident. You can see it everywhere. Obviously, I know anecdotally that there's very little activity in real estate transactions and sales, and obviously there's significant pressure in major urban centers in the condos. They got a lot of units coming on board. The math doesn't quite work. There is definitely some real stress, and you see it. You see it anecdotally, but you also see it in the fact that inflation, ticked down to 1.6 because aggregate demand went down. A lot of it's driven off of the lower energy costs, but again, it could easily tick up. But I think if I look at the U.S., there's one phenomenon that's starting to grow, and we've seen the 10-year treasuries kind of grind up from 3.8% to 4.2%. There's some growing concern about the ability of the world or the United States to kind of finance its extraordinary deficits without
Yep.
um, uh, creditors, i.e., people, institutions, whatever, demanding a little bit more premium. So that's the next kind of scary thing out there. Fundamentally, the economy is really strong. It's good, but yeah, perhaps to quote one of the expressions in the marketplace are what are called bond vigilantes, the people who actually make the decision, no, you're going to have to pay me more if I'm going to take down your debt. Maybe they're coming to life again because the US has definitely seen a backup or bond prices fall or rates go up. So it'll be interesting. We have to monitor it. But I think the one thing that everyone can kind of take away from, given that we had the extraordinary interest rate increases from basically 0 to like 5%, 5.5%, back in 2022, 23, is that we're in a more normalized environment. So interest rates can go up and down, and they will be going up and down depending upon what's going on. There is a pressure to have lower real interest rates, i.e., whatever the inflation rate is, plus the compensation for um, being exposed above inflation, and that's a lot lower than what that rate should be lower than where rates are. But I just think that we're going to have a lot of volatility in interest rates and in the bond markets, more so than we've had in the previous 15 years.
Right.
Yeah. Interesting conundrum we are facing with in Canada. Okay, guys, so some fun details here. First of all, thank you for all those who have invested in our fund here. It is RSP eligible. It is available FundServe, CCI 705. You can get this at your Royal Bank Dividend Securities Advisor as well for credit investors, portfolio managers, SMA accounts. So yes, you guys probably know a lot about this information anyhow. So what are we looking for? Well, we're definitely looking at November as like a strong month. So we're looking for some decent performance from our own initiatives and the portfolio as it stands today. There, absolutely. We are looking for more cuts in the United States and Canada. Like let's see what this Fed Watch is saying for the next few months, right? Let's see where interest rates end off, and more importantly, or potentially more importantly, what is the rhetoric that the policymakers are using, right? And lastly, we have this elephant in the room. It's like an invisible. It's almost like an elephant in the room. It's an invisible elephant. We don't exactly know what it's going to do or its impact, and that is the presidential race. That I think is the forefront for the next month or so. But we'll see where that is landing inside the next month or so, and go from there. But that's generally speaking what we are looking out for. Again, rates, politics. I would actually throw in here like global macroeconomic, global kind of political events as well. But again, very hard to kind of truly look out for that. But certainly
Yeah,
that's in
I was going to
monitoring.
say, Matthew, the one thing that will be really very much dependent on how the market goes is this going to be a contested election or is it not going to be?
I think it's going to be
That
contested.
remains to be seen.
I would say my crystal ball is telling me it's going to be contested. How about yours?
Yeah, I would agree, Matthew.
David, your crystal ball, contested election or not?
I don't think we'll know the outcome.
I don't think we'll know the recent history tells us we won't know the outcome on November the 5th. So
No,
we'll wait. So again, our contact information is here for Omar, for David, and myself. You guys all know us. Please spread the word. We'd love to speak to you guys. And yeah, here's our usual disclaimer. We'll leave this on the screen for a certain amount of seconds, and we'll move on. And thank you so much. Guys, any questions or concerns, please reach out to any of us. We thank you all for your support. And if there's nothing else from the panel here, we wish you a lovely Thursday afternoon.